Hey Bowtie Nation, Joseph Hogue here, and I know 30 years is a long time. Hell, I'll be 75 at that point and probably look something like this. Ugh, that is just awful. What if I shave the beard a little bit? Maybe look... Nope, not so much. But that very same power of time that makes you look like a melted Mick Jagger can also make you a millionaire with what is easily the best investing strategy out there, the buy and hold strategy. To prove how well this buy and hold investing works, just look at an investment in shares of Microsoft 30 years ago. The blue line here is a one-time investment of $1,000, growing to almost 200 times your money. Even better though, investing just $100 a month could have made you a millionaire. All those gift cards you just bought that will never be used could be making you a millionaire. It is as simple as that. So for this video, I'm going to reveal the 7 stocks to buy now and hold forever. I'll show you 3 growth stocks that could be the next Microsoft, Apple, or Amazon for the next 200 times return, along with 3 stocks that will never let you down. Stick around and I'm going to finish it up with my favorite buy and hold ETF for those long-term dividends. Our first forever stock is in one of my favorite future trends, Freeport-McMoRan, ticker FCX. FCX is a global leader in copper and gold mining with low-cost operations in South America and Indonesia, but more importantly, significant mining in the US as well, and I'm going to explain why that's so important in a minute. Despite lower metals prices recently, Freeport is doing everything right, from increased production to higher operating margins and even decreasing debt. Now understand, copper and some of the other industrial metals the company mines are going to sell off in a recession, but we could be about to see a serious shortage of copper and higher prices in the near future. Electric vehicles alone use more than 3 times the amount of copper compared to traditional cars. Copper is also a major component of renewable energy delivery systems along with construction. In fact, in estimates by the International Energy Agency, we see copper production estimates here on the far right in blue, with demand estimates in red, and a deficit by 2024. Within just 1 year, we will not be mining enough copper to fulfill that demand, and that deficit is just going to keep growing. Now recently, the news in copper has been about a startup called Jetty Resources that has found a way to potentially unlock millions of tons of wasted copper through a new process. Basically, in the past, miners have had to sit on millions of tons of a special type of ore that just makes that copper extraction uneconomical. Through a developed catalyst that can unlock the copper trapped in this ore, Jetty and copper miners could see a surge in production to meet that expected demand. Now, without being a mining analyst, this just means there could be a win-win for copper miners. If we see that supply shortage on the transition to electrification, the price of copper could double by 2025 for those huge profits for the miners like FCX. On the other hand, if that process does unlock all this wasted copper, supply is going to increase efficiently and prices might not go up, but that production is going to boom and the miners will still be there to make a lot of money. Their shares of FCX are down 26% from that commodities boom earlier this year and are now trading at 14 times on a price to earnings basis. Now, that is above the low we saw last year, but still well under valuations of 17 times for Southern Copper, which I actually also like on that long-term copper demand story. Freeport has a much stronger balance sheet with only about 40% debt to equity versus SCCO with a debt of 90% its equity. Remember, I said I'd be giving you 3 buy and hold stocks that will never let you down, and I think FCX is one of the best in that copper theme. Now for our first growth stock idea, I like Sofi Technologies, ticker SOFI. This isn't going to surprise you out there in the Bowtie Nation because I have been talking about SoFi since January. And okay, now before I get all kinds of comments on how terrible SoFi is as a stock because it's down over the last year, Nation, you cannot judge the future of a stock just by looking at its past. That's like forever swearing off Apple products because you bought the iPod socks in 2004. I wasn't telling you to buy these growth stocks like SoFi back in 2021 when they hit ludicrous speed levels of valuation. That was some other Yahoo on YouTube or some 15-year-old on TikTok. With the stocks down 81% though, this is still the same growth company, but now the valuation that makes it a good investment. Now SoFi started as an online student loan refinance platform, but has evolved into a full-service fintech wallet and I believe is one of the best positioned for that future of digital banking. Where other fintech platforms like PayPal and Upstart are still trying to bring on their products and services here, SoFi already has a lead in everything finance, from insurance to credit, investing, and banking. And as I've been talking about over the past year, a big part of that is the company's approval for a banking charter through its acquisition of Golden Pacific Bancorp that closed earlier last year. Because most of the fintech companies don't have a bank charter, they just can't offer those services like checking or savings, and they don't have access to those lower rates like a traditional bank. This really does put SoFi way ahead of the competition, and the company is going to be leveraging that for growth. The company reported 61% growth in new members last quarter to 4.7 million, and while the percentage increase is slowing, that is still amazing growth at that scale. To put that into perspective, the company's closest competitor here, Ally Financial, grew its customer base by just 12% last year. SoFi has also reached 124 million accounts on its Galileo payments processing platform in just 3 years and is on track to grow revenue by 51% to $1.5 billion this year. And I think where even the skeptics start to come around on SoFi is if you look at it as a bank stock rather than some high-flying growth stock. Comparing SoFi against the major banks on that price-to-book value of assets and revenue growth, it is a no-brainer. SoFi trades for just 0.84 times book value, and remember, that's the valuation you need to use for banks because they keep all their assets and liabilities updated on the balance sheet. Now, on a price-to-book basis, JP Morgan is almost twice as expensive as that, as 1.49 times, despite having no revenue growth. Even First Republic, one of the fastest growing banks, only has a 17% growth rate versus 50% plus for SoFi. Now, I do need you to understand here, for as long as we're in a bear market, the shares of SoFi and all these other growth stocks will be under pressure, but just like buying Amazon in 2002 at $6 a share after that dot-com crash would have made you 500 times your money, buying these growth stocks now is your best chance at those kind of returns over the next 10 and 20 years. We're just getting into our stock list, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. You might think this next one, Amazon, ticker AMZN, is a growth stock pick, but that e-commerce giant is past its days of 30 and 40% growth. That said, Amazon dominates in its two core markets with nearly 60% of the US e-commerce market, a number no other company even comes close to matching. Amazon also controls a third of the global market for cloud services, 50% more than its next largest competitor. And when you've got that kind of market control, it's an advantage the company is going to use across all its products. Revenue has doubled in the last 3 years to $500 billion and is expected to hit nearly $600 billion this year. So even if it's not that growth stock darling it was a decade ago, it's still just an investment that is going to continue to grow and never let you down. And here, I think the market is underestimating this stock. For a share of Amazon, you're basically paying for that valuation on the core e-commerce platform and its Amazon cloud service, but you're also getting all this other stuff, the Alexa venture investments in AI, voice, and other tech innovations, just kind of as a lottery ticket. And now there's evidence that core valuation itself may also be undervalued. Activist investor Dan Loeb made news last February when he estimated $1 trillion in hidden value for the shares if you just valued the two segments separately in a split of the company. That would make it a $2.5 billion company, or nearly 3 times the current stock price. Now, I've got to be honest with you, I've always had trouble recommending Amazon because it is that expensive valuation, but after this recent sell-off, it's now down to a place I've never seen it before. Shares trade for just 1.7 times on that price-to-sales basis, which is less than half the 2020 valuation. We'll get back to our list, but understand I'm not just pulling these 7 stock picks out of my ass here. I want to show you what I'm looking for in these 2 types of forever stocks that we're buying. What makes them those buy and hold stocks? For those steady stocks, the reliable buy and hold targets that won't let you down, I'm looking for 3 factors here. First here is going to be a long-term trend supporting the industry. It's one of the reasons why, even though oil stocks have made us a lot of money here lately on the channel, and I like energy stocks for the next few years, but why you won't find any of these on the list. We just don't know what that longer-term trend is for that industry. Instead, I'm looking for those industries like copper, e-commerce, and lending. There will always be a disruption in any industry you find, but in groups like these where that upward trend from electrification, online usage, and economic growth is going to help all the stocks in that industry. And once we've found that industry with the positive upward trends, now I want to find the companies with a competitive advantage in that group. The company has to be able to do something that few others in its industry are doing, something that's going to be able to use to leverage that industry growth into even higher returns. That's going to give it the staying power even when the economy tumbles in bear markets over those decades-long period. Finally here, for those reliable buy and hold stocks, we have to come back to valuation. Even a good company with a strong industry trend can lose money if that stock is ridiculously expensive. Just take a look at shares of Cisco Systems at the end of 1999. You've got a tech sector that, even after that crash, was going to be strong for decades to come, and a company that would dominate its industry. But because that valuation was so out of whack at that time, you would still be losing money. I want to reveal that next buy and hold growth stock next, so I'm going to show you what I'm looking for here later. Our next growth stock is another favorite of mine, Teladoc Health, ticker TDOC. Now, this is another one I started buying last January after that massive crash from the 2021 price, and again, I know a lot of you are just going to write this one off immediately after looking at the stock chart. Even on a cost basis of $35 a share, I'm still down 29% on 2,200 shares, but this is still the same growth stock it was, and this stock easily gets to $150 a share in the next 3 years. Teladoc is a global leader in virtual healthcare with a provider network that covers 76 million US patients and 1 billion member data points from traditional telehealth to remote monitoring and next-generation primary care. And obviously, the pandemic years were huge here, like 5 years of growth all in one, but the company was already growing at a solid rate before that. Membership growth has grown 33% annually since 2018, and the company booked over 18 million patient visits in the last 4 quarters. Even on the slowdown, revenue grew at 18% last year to $2.4 billion, and 80% of that is from recurring services. So kind of like this one for the stability, even if that growth for telehealth slows from that pandemic pace. Longer term here, telehealth and virtual care is just going to be the future of medicine, but I think the data is really the undiscovered value here, processing all that patient data for the analysis and the research. And again, we're just over the last couple of years. Teladoc was the poster child for those expensive growth stocks. The sell-off has now taken this down into really attractive territory. Teladoc now trades for just 1.8 times on a price-to-sales basis, but is still growing revenue by double digits a year. The company is still targeting sales of $3.5 billion through 2024, and with a more reasonable price valuation at even 4 times sales, that is a $14 billion market cap and more than 200% return on the stock. But hold on to this one for the next decade, and this could be the Amazon of healthcare. For these growth stocks, I'm also looking for those long-term growth trends. Which industries have the strongest growth over the next 20 and 30 years? It's in these industries like virtual healthcare, Web 3.0, and fintech that are changing our lives, and even those also-ran stocks are going to post huge returns. But we don't want the laggards here, even in these growth trends, so we're going to be looking for companies dominating those industries. Here I'm looking for stocks with a market position well above the next largest competitor or some other defensible advantage over its peers. And finally here, because a lot of these growth stocks are on kind of shaky ground right now, I'm also looking for companies with a balance sheet that can survive. And that means enough balance sheet cash and lower debt to survive any kind of economic storm until that industry trends returns. From growth back to value with another bank stock here, Citigroup, ticker C. Now, all you out there in the nation know I followed bank stocks last year as interest rates rose. That net interest margin, that's the difference between the rate that the banks pay you on your savings account, that super low rates, and then the rate they collect when they lend out your money. That's that key profitability for banks just fell off a cliff over the last few years, but is now heading higher. In fact, Mike Mayo, managing director at Wells Fargo, is estimating that the profitability from that net interest margin over the next 2 years could be the highest it's been since the 80s. Point in fact, the Fed published its stress tests on the banks last June and found that the industry capital requirements were so strong that analysts expect the largest U.S. banks alone to return more than $80 billion to shareholders in dividends and share repurchases over the next year. That cash payout and the returns from the higher margins were put on hold last year for fear of recession and loan defaults, but these bank stocks are now making more money and ready to rebound into the next bull market. And remember the valuation chart I showed you earlier with that price-to-book values? Shares of Citigroup trade for just 0.48 times book value. That's about the lowest in the industry, and the stock pays a 4.6% dividend while you wait. For this one, you're either going to roll your eyes or laugh at this next growth stock, but shares of Meta Platforms, ticker META. And that's fine, laugh all you want, but I have no doubt that within the next 10 years, we will be in more of an immersive internet experience like the metaverse. It's not going to be like Ready Player One yet, but it will be more of a virtual experience, and Meta is going to dominate that just like it dominates social media. The company counts more than 3 billion monthly users across Facebook, WhatsApp, Instagram, and Messenger, well beyond any other social company. And yeah, that Apple privacy changes and the plunge in ad revenue from the economic slowdown have dropped the share 70% from its peak, but these are all temporary problems. Facebook is going to find a way around that targeting problem in ads, and ad spending will eventually boom with the economy. I think solving just those two problems takes the shares back up to $200 each by 2025, but then you get that growth from the transition to a virtual internet experience. Meta's Oculus Quest controls 90% of the virtual headset market, and even though investors don't like it now, the company is spending heavily to dominate that next generation of the internet. That's going to turn it back into a growth stock by the end of the decade. Those are the 6 stocks in my buy and hold forever portfolio, but as a bonus, I want to share my favorite long-term ETF, the fund I will always own to complement those buy and hold stocks. But first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. The Schwab Dividend Equity ETF, ticker SCHD, won't make you rich like some of these other stocks might, but it will give you both dividends and returns for as long as you hold it. The Schwab ETF holds shares in 100 of the highest dividend payers within the large cap US market and includes a lot of that faster growing tech sector as well. Tech makes up 20% of the fund, giving it a return plus a strong 3.2% dividend yield. The fund covers all its bases here with Coke and Pepsi, but also some of those dividend stocks you might not see in other dividend funds like Cisco Systems and Broadcom. It has been all about stocks in this video, but don't neglect bonds either. Click on the video to the right for the one bond ETF every investor needs for safety and cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.